What's going on, everybody? Chris here from projectoption.com, and welcome back to the ultimate guide to trading vertical spreads. Now, as an options trader, you have virtually unlimited amounts of expiration cycles you can choose from. So in this video, we're going to talk about choosing an expiration cycle when you're trading vertical spreads. So with so many expiration cycles to choose from when trading options, which ones make sense for trading vertical spreads? Now, like many things in options trading, there's not one definite answer that rules all, but since vertical spreads can only achieve maximum profitability if the extrinsic value in the spread reaches $0, it's common to trade vertical spreads with around 30 to 60 days to expiration. Now, why is that? Well, to put it simply, longer-term options trade with more extrinsic value, and that extrinsic value decays pretty slowly. On the other hand, shorter-term options trade with less extrinsic value, and that extrinsic value tends to decay pretty quickly, especially when you're going into the last week of expiration. Now, what does that mean for selecting an expiration cycle when trading vertical spreads? Well, if you trade a longer-term vertical spread and get a favorable movement in the stock price, your profits will typically be smaller than if you had traded the same spread with shorter-term options. And of course, this is holding all else equal, and this is kind of a general statement. Now, on the other hand, if the stock price moves against you, then a longer-term vertical spread will be more forgiving than a short-term vertical spread, which means you'll just typically have smaller losses in that longer-term spread. Now, let's take a look at an example to show you exactly what I mean. So for this demonstration, we're going to look at some long call spreads in Netflix from 2017. Now, the first trade we're going to look at is the May 2017 140-160 call spread that is purchased for $8.74. Now, these May options at the time of entering the trade have 46 days to expiration. Now, the second trade we're going to look at is the June 17 140-160 call spread that is purchased for $8.95, and these options have 74 days to expiration when both of these trades are entered. So we're basically just comparing the same call spread in two different expiration cycles, and we're going to compare their P&L as the stock price is moving through time. Now, on the chart on the right, we're looking at the changes in the stock price relative to the strike prices of this call spread that we're comparing in two different expiration cycles. And on the bottom part of the chart, we're looking at the P&L of each spread as the stock price is changing. Now, here are the key takeaways from this chart. When the stock price moved unfavorably between 32 and 24 days to expiration, the longer-term spread suffered slightly smaller losses than the shorter-term spread. Now, the second takeaway is that when the stock price moved favorably between 24 and 0 days to expiration, the shorter-term May call spread had more profits than the longer-term June call spread. Now, that's because the shorter-term May call spread has less extrinsic value than the longer-term June call spread. So when the stock price moves favorably, the shorter-term call spread is going to perform better than the longer-term call spread, and that's because that shorter-term call spread has less extrinsic value and can therefore get closer to the maximum profit. Now, on the previous slide, we just looked at some historical examples, but let's go ahead and look at some current vertical spreads and analyze the difference between two different expiration cycles. Alright, so for this example, let's go ahead and look at Apple options. So as of now, Apple is trading for $153.32, and let's say a trader has a bearish outlook for Apple over the next 30 to 60 days. So what we're going to do is we're going to look at buying a put spread by buying the 155 put and then selling the 145 put, and we're going to compare two different expiration cycles to see the difference between choosing a shorter term or a longer term put spread. Alright, so I've pulled up Apple's option chain, and as we can see here, there are many different expiration cycles that we can choose from. Now, as I said before, we're going to look at the 155, 145 bear put spread, and we're going to look at the same spread in two different expiration cycles. So the first one we're going to look at is the short-term expiration cycle, and we're going to use the August expiration with 22 days to go. Now, for the longer-term expiration cycle, we're going to look at the October expiration with 85 days to go. So first, let's queue up the 155, 145 put spread in August. And as we can see, the spread is trading for about $4.15. So I'll just lock that in. Now, if we go to the October expiration cycle and queue up the same exact trade, we can see that this spread is trading for about $4.40. So I'll go ahead and lock that in. So now let's go to the risk profile and analyze the estimated P&L based on Apple's price movements today. So right now, Apple is trading around $152.50, and as we can see, the P&L is basically zero right here. So what would happen if Apple fell to $140 today? Well, if Apple fell to $140, the estimated P&L on the August put spread is expected to be around $435, and we can see that in the lower left-hand corner. Now, what about the October put spread? So if Apple fell to $140 today, the longer-term October put spread is only expected to be up about $295. So this confirms what I told you before, that if you get a favorable movement in the stock price, a shorter-term vertical spread will typically have better profits than the longer-term put spread or vertical spread, and that's because the shorter-term spread is going to have less extrinsic value and can approach the maximum profit potential much more quickly than a longer-term vertical spread. Now, what happens if the stock price moves against us? So what would happen if Apple moved to $160 today? So we're going to start by looking at the August put spread, which is the short-term spread. So if Apple goes to $160 today, the estimated loss on this put spread is expected to be $227. Now, what would happen if we were instead trading the longer-term put spread? Well, if we were trading the October put spread and Apple did the same move and went to $160, this spread is only expected to be down about $150. So as I said before, if you're trading a longer-term vertical spread and the stock price moves against you, your losses will typically be smaller, and that's because the longer-term vertical spread is going to be trading with more extrinsic value, and therefore that spread is going to be holding on to more value and your losses will be smaller. Alright, well, hopefully you found those demonstrations helpful. If you still have any questions, please drop a comment down below and I'd be happy to help you. Now, to quickly recap, when trading vertical spreads, selecting an expiration 30 to 60 days to expiration is common because of the time decay in shorter term options. Now, this is sort of a guideline and it's not a hard and fast rule, and the reason for that is when trading options there's always going to be exceptions, and sometimes you might want to trade a longer term spread or sometimes you might want to trade a shorter term spread depending on the situation. Now, that 30 to 60 day window is quite common because you get nice extrinsic value decay as time passes, but you also have enough time to recover if the stock price moves against you. Now, the first main point to take away from this video is that when the stock price moves favorably for your spread, shorter term vertical spreads will typically profit more than longer term vertical spreads. So in other words, if you're correct on your directional assumption, you'll be better off with a shorter term vertical spread than a longer term vertical spread. Now, on the other hand, when the stock price moves unfavorably and moves against your spread, longer-term vertical spreads will typically suffer less severe losses than shorter-term vertical spreads. So there's always a give and take with options trading, and in terms of choosing an expiration cycle, if you choose a very short-term expiration cycle and the stock price moves against you, you're pretty much done. However, if you have a longer-term expiration cycle in your spread and the stock price moves against you, you'll suffer less severe losses and you'll also have more time for the stock to recover. Alright, well, that pretty much sums up this video. If you have any questions, please drop a comment down below and I will get back to you personally. Now, in the next video, we're going to talk about selecting strike prices when trading vertical spreads. I'll see you there.